All right, hi everybody. We are now on episode 2 of Business by the Bar. Nobody's given me a better name, so I think that's what we're going to stick with, okay? So first things first, I need to grab a drink. And little known fact, I tend to like scotch more than bourbon. So today I'm doing a Wolfburn peated scotch. Love that sound. Nice and pale, very, very smoky. Okay, so Business by the Bar, we talk business by the bar. So today I'm gonna go over something that happened this week. I had a conversation with a member of Security Owners Group, and he was telling me about the size of his business. He wanted to know if he should take part in an event that we're putting together. At the end of the day, I said, you probably shouldn't, because it's geared more towards companies that already have operations in place with multiple employees and things like that. But it got me thinking, how do you get from a one-man show to having an operation? So that's what we're going to talk about. And there is a process in place that most people don't think about, okay? And I'm sure most of you have heard me talk about some of this stuff, but I'm going to put it out there as a plan to get to where you need to be if you are a one-man show and you're trying to build an operation that's going to last longer than you are, and where you're going to be able to take a week or 2 or 6 off at some point or another, okay? So first things first, you have to pay yourself as an employee from day one. Okay, that means you're going to give yourself a W-2 or you're going to give yourself a 1099, whatever it is, however you're going to set that up, talk to your accountant and figure it out. But I highly recommend you give yourself a W-2 as a paid employee to do the job that you are doing, because you have 2 roles. One is the person who runs the business. That person gets paid. If you ever want to take time off and not be working nonstop, you're going to have to pay someone else to do that. Okay, so while you're building the business to be profitable and grow and sustainable, you have to be able to pay yourself as if you are paying someone else. Okay, and it has to be reasonable. So if the business isn't doing enough that it's a reasonable amount of money you're making, then you probably need to fix the business before you move into anything else. Okay, so step 1, pay yourself. Step 2, you need to act as if you already have the expenses. All right, that means that you can't take a job at a super low margin just because you have no overhead. So you have to assume that at some point you're going to need to have a project manager that you're going to pay. At some point you're going to need to have an office manager. At some point you're going to need to have somebody building systems. At some point you're going to need to hire technicians, and you're going to need to do all of the other stuff that we do. All right, your insurance, by the way, is going to skyrocket as soon as you hire a couple people. So you have to plan for that. If you're used to paying a few $1,000s a year, $3,000, $4,000, $5,000 a year for your insurance, once you get to the point that you've got several employees, you better be ready to spend $20,000, $30,000 a year on your insurance. So you have to plan for that early. All right, how do you do that? My methodology that I like is Mike Michalowicz Profit First, okay? It is very simple to follow, and I would modify it a little bit for companies that have a single employee, right? So the concept behind that book, which is an entire methodology, is to, instead of looking at how your business works as sales minus expense equals profit, right? It's sales minus profit equals expense, all right? So that's hard to wrap your head around, even though it's very simple. But you need to predetermine what your profit is going to be, okay? The industry operates at about a 7% net. Most people get down to 4 or up to about 15. When you have a single person running a business, it's not uncommon to see a company run 20, 25% net, but they're taking all that money as if it's theirs, okay? It's not. You're going to need that money to run the business, okay? So if you're looking at even a 5% profit on a cash basis using Profit First, you've got 95% of your money left over. You need to look at a payroll account, and you need to look at an operating expense account. Okay, so all of your materials, all of that stuff, you'll pay out of your operating expense account. You'll pay yourself out of the payroll account, and then your profit account gets saved for whatever you want to use it for. Okay, I've got some ideas. Buy whiskey. So once you've done that, what you'll find is that you'll start to build cash reserves. Okay, if you're selling properly. So you'll have enough money to pay yourself. You'll have enough money to build that payroll account beyond what you're paying yourself. And when it's time to hire that first person, it's not nearly as risky because you're investing. You're taking money you've already earned and putting it towards a human resource, towards a person that's going to help you continue to build that business, instead of saying, I'm going to hire someone and hope they sell enough, hope they can install well enough and fast enough that we make more money. That's not how you build. That just creates more risk. Okay, so start paying yourself, read Profit First, start splitting your money as it comes in immediately, and get used to paying bills and paying yourself and paying everything twice a month, so that you're not spending random days doing accounting. You're not spending random days wondering if you've got enough cash. You can look at the bank account, at the income account, and figure out, oh, I've got X number of dollars. Last period I had X number of dollars. I'm doing better or I'm doing worse. And it's very, very simple. And you can focus on building and growing the business. Okay. So how do you figure out what those percentages are? Well, there's kind of some industry standards in one of the other videos that I go over. It was pre-pandemic, but the numbers still kind of apply. All right. And you want to be a little bit conservative on this, because you can always make changes, but you really shouldn't change your percentages drastically. Okay. So sole operator, you're going to look at how a bigger company operates, and they're going to spend, 20% plus on payroll. So if you're selling, for every $100,000 that you're selling in a year, you need to take $20,000 as the money comes in and set it in a payroll account. And that's how you're going to pay yourself. Okay. Operating expense, really, really, really well operating companies are done at 35, 36. But it's got to be a really well operating company. Most companies are upwards of 40 to 45, 48% operating expense. If your margin is really high, that works. So you need to take that money out of every a check that comes in from a client, and that goes into the operating expense account. Your operating expense account is what you pay for all your materials and your insurance and your trucks and everything else. Okay. So if you're acting as if you already have these expenses when cash comes in, you are going to run a much leaner operation, and you're going to be setting cash aside for those investments that need to come. So when you do get a warehouse or an office or any of that stuff, you've already got 2 or 3 months of your rent already saved. Your operating expense account has been growing. If you've read the book, then you know if you got an expense coming up, you should create a separate account for that expense and plan for that cash to go out. Okay. This is really hard when you're the only person, because you think, oh, look at all this money I have, I'm doing really well. But next year, you're not going to have enough cash to do what you need to do, to hire someone, to buy that van, to do whatever it is that the business needs to do to grow into an actual operation, an enterprise, and not just a sole operator. Okay. So step 1, pay yourself. Step 2, act as if you already have those expenses and don't touch that money. All right. Put that in the account that it needs to go to. And then once you make the decision, it's a much easier decision if you've got some cash sitting around. Okay. Some targets to hit. We like to operate with at least 2 months of payroll sitting in the payroll account, so that we are never uncomfortable if there's ever a delay in cash flow and an increase in overtime at the same time. Okay. If we hit a snag in operations or in sales, then we don't have to worry about that short-term cash flow, and we can figure out how to direct the team and use the team's skills and resources to correct whatever is wrong on the outside. Okay. That's part of how we weathered COVID. It's part of how we just operate the business. So same thing with OpEx. We like to have a cushion of our normal operating expenses in any given month. We like to have that there and available. Okay. I've got extra accounts in my Profit First setup. I'm happy to work with people on that kind of stuff. I'm not a Profit First advisor. I'd recommend, if you want someone professional to do Profit First setup, that you reach out to Mike Michalowicz Group, which is Profit First Professionals. But honestly, it's pretty self-explanatory and fairly easy to do. So once you've done that, the key is going to be leaving that cash there until you're going to use it for what you intended. Okay. If you're putting 40% of the money that comes into your business into an operating account, and you don't have a bunch of vans, and you don't have a bunch of crazy insurance bills and payroll expenses and health benefits and all the other stuff, that money is going to grow very quickly. It's going to be very tempting for you to say, oh, we're doing well, I've got all this cash, I'm just going to take it. I'm going to pay myself, I'm going to reward myself for owning the business. And you can't. Not if you're going to grow it. The account you can touch is the profit account. So be very careful, because there's a balance there between what you put in the profit account to reward yourself as the shareholder for the company, and on the other side of that, keeping that number low until you've built enough of a business that it's self-sustaining. And it's going to take years. It's not going to be something you do in 1 year or 2 years or 3 years when you're first starting out, unless you've got a ton of cash to start and you're very comfortable letting go of the reins for somebody and hiring somebody who knows how to do that. Most of us don't do that. Even those of us who are comfortable letting go of the reins aren't comfortable at that level and that early on. So I would suggest following that process and just being tenacious, never giving up. Live on what your business can pay you. And if it's not paying you enough, then it needs to sell more, right? So if you've got some cash reserves, you can make a plan to sell more. Your cash reserves will increase, and it is a cycle of positivity instead of what most business owners are in the sub-$1 million category, at least in service, which is a circle of banging their heads on the wall, right? So highly advise you follow that advice and build your business. I'm finally going to take a drink.